Look, I've been doing this for 35 years. I ran a hedge fund. I worked at Goldman Sachs during some of the craziest market periods in history, and I can tell you something right now that most people don't want to hear. What you're experiencing isn't a bear market, it's a bear trap, and if you don't understand the difference, you're going to make the same mistake that's destroyed retail investors in every single cycle. 4 months ago, Bitcoin was at $126,000. I had people messaging me constantly saying, Raoul, I missed it. If only it could come back to $80,000. If only I could get one more chance. Well, here's your chance. Bitcoin is sitting at $72,000. That's a 42% drawdown. And what are those same people doing now? They're selling. They're panicking. They're convinced it's going to zero. This is the psychology of markets. This is what I've studied my entire career, and it never changes. Before we go deeper, make sure you subscribe and hit the notification bell. What I'm about to show you is the macro framework that's guided my entire investment thesis. This is how institutions think about these moments. Now, let me ask you something in the comments. Are you accumulating or are you capitulating? I want to know where you stand. The macro framework, here's the thing. Most people look at Bitcoin as a speculative asset. They look at price charts. They look at candles. They react to volatility. That's not how I think about this. That's not how any serious macro investor thinks about this. When I look at Bitcoin, I see a network. I see adoption curves. I see Metcalfe's law playing out in real time. Let me explain what I mean. When you evaluate a network, whether that's Facebook, the internet, or Bitcoin, you don't look at daily price fluctuations. You look at network fundamentals. You look at adoption metrics. You look at the underlying growth of the system. So let's do that. Let's ignore price for 5 minutes and evaluate Bitcoin as a network. Network security. Hash rate first. Hash rate. This is the total computational power securing the Bitcoin network. When Bitcoin was at $126,000 in October, the hash rate was strong. Today, at $72,000, the hash rate is at an all-time high. Let me say that again because it's important. Bitcoin is more secure today at $72,000 than it was at $126,000. The miners, the entities that secure this network, they haven't left. They haven't turned off their machines. They're still mining. They're still building. If this network was broken, if this asset was dying, miners would be capitulating. They would be selling equipment. They would be shutting down operations. They're not. Hash rate at all-time highs tells you everything you need to know about the underlying health of this network. Supply dynamics, the great accumulation. Second, let's talk about supply dynamics. Where is the Bitcoin? Who owns it? In October, there was significant Bitcoin sitting on exchanges, ready to be sold. Today, exchange reserves are at multi-year lows. Bitcoin is being pulled off exchanges. It's being moved into cold storage. Long-term holders are not selling. In fact, wallets holding more than 10 Bitcoin, what we call whale wallets, have been accumulating throughout this entire drawdown. Think about what that means. While retail investors panic, while weak hands capitulate, while the headlines scream crypto winter, sophisticated money is quietly absorbing every Bitcoin that hits the market. The supply available for sale is shrinking despite a 42% price decline. This is not what happens in a bear market. This is what happens in an accumulation phase. Leverage flush. The Great Reset. Third, leverage. This is crucial. In October, the market was loaded with leverage. Futures contracts, margin positions. Everyone was betting on higher prices using borrowed money. That's inherently unstable. That's a market primed for a violent correction. Well, the correction happened. Over the past 4 weeks, $2 billion in leveraged long positions got liquidated. Wiped out, gone. And you know what that means? The market is clean now. The tourists are gone. The gamblers are gone. The weak hands are gone. What's left? Holders, believers, people with conviction and time horizons longer than 2 weeks. A market without excessive leverage is a healthy market. It's a market that can sustain a rally, not a market about to collapse further. The fundamental truth. So let me ask you something. If the network is more secure than ever, if sophisticated, money is accumulating, if leverage has been flushed, if supply on exchanges is at multi-year lows, then what exactly got worse? Nothing. The fundamentals didn't change. The price changed. And price is just a reflection of short-term psychology. Price is noise. Fundamentals are signal. If you're finding this framework valuable, hit that like button. This is the kind of institutional thinking that most retail investors never get access to. The supermarket analogy. Let me give you an analogy I use all the time. Imagine you go to the supermarket every week. You buy the same cut of steak. It's your favorite. It costs $20. You buy it without thinking. One day you walk in and that same steak is $12, same quality, same supplier, nothing changed except the price. What do? You load your cart, you buy 3 steaks instead of 1, you tell your friends about the deal, You don't ask, why is the steak so cheap? Is the cow sick? No, you just buy the discount. Now let's go to financial markets. Bitcoin was $126,000 4 months ago. Today it's $72,000. Same asset, same network, same fundamentals, 42% discount. And what does everyone do? They panic, they sell, they convince themselves the asset is broken. Why? Because in financial markets, price dictates narrative. When price goes up, everyone's a genius. When price goes down, everyone's a pessimist. But here's the difference between the supermarket and the stock market. When you buy steak, you eat it tonight. The feedback loop is immediate. When you invest in Bitcoin, you have to wait. You have to endure volatility. You have to survive drawdowns. And that's where most people fail. Position sizing. The only thing that matters now, here's where I need to be very direct with you. The only people who can handle this volatility are people who invested money they don't need, money they can afford to lose, money they won't touch for years. If you bought Bitcoin with your rent money, you're going to panic. If you bought Bitcoin on margin, with borrowed money, with credit cards, you should be scared, because you're not investing, you're gambling, and gambling with money you need is how you get destroyed. But if you allocated 1%, 5%, maybe 10% of your portfolio to Bitcoin, money you genuinely don't need for the next 5 years, then this 42% drawdown is just noise. It's just volatility. It's just the price you pay for asymmetric upside. Let me be crystal clear. I am not telling you to buy Bitcoin. I'm not giving you financial advice. I'm showing you a framework. I'm showing you how to think about these moments. What you do with that information is your decision. But whatever you decide, make sure it's with money you can afford to lose. Make sure you can sleep at night, because if you can't sleep, you're overexposed. And if you're overexposed, you will sell at the bottom. Drop a comment. Are you sleeping well? Or are you losing sleep? Let's be honest with ourselves. The macro divergence now. Let's talk about something that's really interesting to me as a macro investor. The S&P 500 just hit 7,000 points, all-time highs. Meanwhile, Bitcoin is at one-year lows. Stocks are ripping. Crypto is bleeding. What's going on? This is what I call a temporary liquidity rotation. Money didn't disappear. Money just moved. Capital flowed out of high-risk assets like crypto and into moderate-risk assets like tech stocks. Why? Fear. Narratives around tighter monetary policy, risk-off positioning. Investors got scared, so they moved their money from Bitcoin to equities. But here's what 35 years of watching markets has taught me. These divergences don't last. They're temporary, they're inefficiencies, and when they close violently. Historical pattern recognition. Let me show you what happens when Bitcoin and equities diverge like this. In 2020, during the COVID crash, stocks recovered quickly while Bitcoin lagged. Everyone thought Bitcoin was done. Then Bitcoin went from $10,000 to $69,000 in 18 months, in 2016. Stocks were making new highs while Bitcoin was consolidating around $600. Everyone thought Bitcoin was irrelevant. Then Bitcoin went from $600 to $20,000 in 18 months. The pattern is always the same. Bitcoin lags during fear, then Bitcoin explodes during the recovery. Why? Because Bitcoin is a leveraged bet on global liquidity and risk appetite. When risk appetite returns, Bitcoin doesn't just catch up, it overshoots. Right now, Bitcoin is a compressed spring. The S&P is at 7,000. Bitcoin is at $72,000, down 42% from its high. This gap cannot persist indefinitely. Either stocks crash down to meet Bitcoin, or Bitcoin rallies up to meet stocks. And given that the economy is expanding, corporate earnings are strong, and liquidity is still abundant, which scenario is more likely? I'll let you decide. The MVRV framework. Now let me show you one more piece of data. It's called the MVRV Z-Score. Don't worry about the technical name, just understand what it measures. The MVRV Z-Score compares Bitcoin's market price to its fair value based on on-chain data. When the Z-Score is high, Bitcoin is overvalued. Euphoria, bubble territory. That's when sophisticated money sells. When the Z-Score is low, Bitcoin is undervalued. Capitulation, blood in the streets. That's when sophisticated money accumulates. In October, when Bitcoin was at $126,000, the MVRV Z-Score was elevated. The market was heated. Risk was high. Today, at $72,000, the MVRV Z-Score has reset. It's back in the accumulation zone. This is the zone where, historically, across multiple cycles, Bitcoin has formed bottoms and started new rallies. What does this tell you? It tells you that Bitcoin was expensive at $126,000 and is now fairly priced, possibly underpriced, at $72,000 based on historical on-chain metrics. But here's the critical part. This is not a prediction. This is not a guarantee. This is just data. Could Bitcoin drop to $60,000? Absolutely. Markets overshoot. Could we chop sideways for 6 months? Yes. Could I be completely wrong? It's possible. The point is this: if you're going to participate in this market, you need to understand the metrics, you need to understand the data. Not so you can time the perfect bottom, but so you can make informed decisions instead of emotional decisions. Productive fear vs destructive fear. Let me bring this home. Bitcoin is at $72,400. It's down 42% from $126,000. The market is bleeding. Fear is at extreme levels, and being scared is completely rational. This is scary. Watching your investment drop 42% is painful. But here's the difference between productive fear and destructive fear. Productive fear makes you ask, am I overexposed? Destructive fear makes you ask, is Bitcoin dead? One is a question about your position. The other is a question about the asset. Those are very different questions. If you're scared because you invested too much, because you used money you need, because you're leveraged, then your fear is valid. Reduce your position. Get to a place where you can sleep at night. There's no shame in that. That's responsible risk management. But if you invested money you genuinely don't need, money you can afford to lose, money you won't touch for years, then ask yourself, what exactly am I scared of? Am I scared because the asset is broken? Or am I scared because the price is volatile? Because if it's the price, then you're reacting to noise, and noise is just part of the game. The fundamentals are screaming. Let me recap what the data tells us. Hash rate at all-time highs, long-term holders accumulating, exchange reserves at multi-year lows, leverage flushed, MVRV Z-Score in accumulation territory. The network fundamentals are solid, the asset hasn't broken, the price has just done what Bitcoin prices always do, swing violently, up 40% in a month, down 40% in another month. That's Bitcoin, that's the nature of the asset, and if you can't handle that volatility, then Bitcoin is not for you, and that's okay. But if you can handle it, if you're properly positioned, if you're investing responsibly, then this is not the time to panic. This is the time to zoom out, to think in decades, not days, to remember why you invested in this network in the first place. What I'm not saying, let me be very clear about what I'm not saying. I am not telling you to buy Bitcoin. I am not telling you to hold Bitcoin. I am not giving you financial advice. I don't know your financial situation. I don't know your risk tolerance. I don't know your time horizon. What I am doing is showing you the framework, the fundamentals, the on-chain metrics, the historical patterns, and I'm asking you two separate emotion from analysis, two separate fear from logic, to make decisions based on your situation, not based on what the market is making you feel. The three futures. Here's the reality. 6 months from now, you will look back at this moment. You will see Bitcoin at $72,000 on the chart, and you will have one of three reactions. 1. I'm glad I sold and reduced my exposure because I was overexposed and needed that capital. 2. I'm glad I held because I invested responsibly and the fundamentals were sound. 3. I wish I had accumulated more because the data was screaming opportunity and I let fear win. Which one of those will you be? Only you can answer that. But whatever you choose, make sure it's based on rational analysis of your financial situation, not based on panic, not based on FOMO. Final thoughts. Here's my challenge to you. Build conviction through education. Study the fundamentals, understand the metrics, know what you own and why you own it. Because conviction built on knowledge allows you to act when everyone else is frozen. Conviction allows you to sleep at night even when the price is dropping. Conviction separates investors from gamblers, but conviction without proper position sizing is recklessness. So before you do anything, ask yourself, can I afford to lose this? Can I afford to wait years for this thesis to play out? Can I sleep at night with this allocation? If the answer is yes, then you have clarity. If the answer is no, then you have work to do. If this gave you a new perspective, hit that like button. Subscribe if you haven't. Turn on notifications. We're going to continue analyzing these markets with data, not emotion, with frameworks, not fear. Drop a comment, conviction or panic. Let me know where you stand. Bitcoin bleeds at $72,000. You are scared, but maybe you're scared of the wrong thing. Maybe you should be scared of being overexposed, not scared of the asset itself. Study the data, manage your risk, invest what you can afford to lose, and let the fundamentals guide you, not the price. This is the exponential age. And in the exponential age, volatility is the price of admission. Thanks for watching. I'll see you in the next one.